how do you structure equity compensation of key players in a company? How do you split salary, equity, and bonus? What are the different types of equity? In fact, a lot of employees who own equity actually don't know what this means for them, which is why this Linqto learn is called the Authoritative Guide to Equity Compensation. Who is the authority? Joe Wallin. Joe Wallin is a corporate lawyer who has been helping early stage companies and investors since the late 1990s. He is the author of Holloway Guide to Equity Compensation and Angel Investing Start to Finish. He is also the current chair of the Angel Capital Association's Public Policy Advisory Council. We've got a ton to learn, a lot to get through, and Karim is going to kick this whole thing off. So Karim, over to you.
Irene, thank you so much. Joe, welcome to the show. I know we started a little bit earlier, but I always have burning questions. So wanted to get some of that off. So let's get started. If you want to talk a little bit more about yourself, perhaps points that Irene did not cover, it's just a personal story of who you are and why is it that you do what you do, and so that we know you, so we can get to know you better.
Sure, I appreciate it. Yeah, thanks, Irene, for the nice introduction. Very nice to be here, Karim. Yeah, I sort of lucked out. And when I went to law school, I thought when I was in law school that I wanted to be a tax lawyer, and so I made plans to continue my legal education after graduating law school. I made plans to go to NYU and get a tax master's degree, and I did that. And I started down the pathway of being a tax lawyer, like full time, or tax professional full time, and then. Maybe a couple of years into that, I met a group of corporate lawyers who were having really a good time and were really fun. And I decided, well, I want to be a corporate lawyer more than I want to be a tax lawyer. And so I wound up sort of evolving in that direction, became a company, early stage company lawyer. I was fortunate enough to fall in with a group of really super active early stage company lawyers in the Seattle area, and doing really fun deals. Seattle's been a great community for early stage companies, startup companies. So I got involved in that sphere around 97 or 98. And my tax background turns out to be helpful in a lot of places, especially in the equity compensation arena, because a lot of what we do in equity comp is driven by taxes. I mean, there's securities law overlays as well. And there used to be, more. Back when I started practicing law, we had, I don't know if you recall, the pooling of accounting methods of accounting, but it used to be that accounting, before they changed the accounting rules, accounting was a much bigger issue with regard to equity compensation because you could avoid accounting charges entirely. But now we take those into account on non-cash charges to earnings for option grants and similar things. But so there's a good overlay in the equity comp area of taxes and securities laws. And we do here at the law firm I'm with, Carney, Badley, and Spellman in Seattle. We're a Seattle-only firm, about 50 lawyers. We do a ton of early stage company setups. Usually we always set up these new companies with equity incentive or stock option plans. And after getting the founders and their shares and the setup done, including the adoption of the equity incentive plan. Usually, one of the next things that happens in the lives of these companies is they want to grant equity to someone, an advisor, and their first hire, their first employee, or contractors they're hiring to work with them to build whatever they're going to build. And so equity comp is a big part of what we do. And so I spent a lot of time talking to people about it and learning about it, and there's lots to learn. So it's a fun area. But yeah, that's a little bit about my background. Hopefully that's replete enough.
Thank you. I appreciate that, Joe. So let me set a little bit of a context here. I know we have some attendees here who have been long-time Linqto fans in the ability to purchase equity that we have on our platform, but a little bit of a background of Linqto, why we started what we do, and the business methodology, and why this conversation is relevant. So we decided to democratize access to private equity companies that have not gone public yet. And we settled on the idea that we should be acquiring through the secondary market equity positions in mid to late stage growth companies before they went through an IPO or an M&A, before they found liquidity. And generally, we look at companies at a valuation of 500 million and above, and a lot of unicorn companies, or a lot of these companies are on our platform, and we allow accredited investors to invest in these companies. It's build your own portfolio by point, click, and invest. We've now started a trading platform which allows almost sort of like a Robinhood environment where you can actually trade your positions through an LLC-led series of the positions you may buy in private companies. So we're going towards democratizing access at a low entry point in terms of dollars. And then if you see the company growing, the company delays its IPO or liquidity event, you still have the opportunity to make out if the company starts to continue to grow and the valuation goes up. So valuation, so the secondary market is where we acquire shares in. Now, there's a lot of complications that we are starting to see, whereby what are the different kinds of equity that exist to employees, founders, advisors, and investors? What are the different kinds of equity positions that they have? How do we identify valuation of that position? Oftentimes, a lot of companies have these days, especially the unicorn companies, 2020, 21, 2018, 2019, were flush with cash, and the valuation of those companies were much, much, much higher than the fundamental business valuation according to revenue, or the 409A valuation that is required by most companies on a yearly basis, or a material event in their company. So as we look through this, give us a scenario of, first of all, how equity compensation is created. What are some of the different kinds of equity that exist, some of the limitations on that equity, and the tradability of that equity that private companies may have. Sure. And then I've got a follow-up just to keep it in mind. We see a lot of confusion today by employees who have stock options, need to convert to shares. They perhaps don't understand the tax implications, the restrictions that the company creates, because it is an asset that they own, and that sometimes gets confusing.
For sure. Yeah. Well, I think one thing that sort of is helpful to keep in mind as you're trying to figure out what's going on in this area is that the taxes drive a lot of the behavior in this area. If we could start a company and we could pay people in shares on a non-taxable basis when they completed the work, that would be simpler and easier for us to understand. And that would enable us to do would be to hire someone and say, hey, we want you to do the following things. When you've completed the following things, we'll issue you some shares. Current federal tax law creates a problem with that scenario because, one, the service provider is helping to increase the value of the company, and under the current U.S. tax law, when we issue them the shares upon completion of the work, the tax law treats that transaction as if we paid the person cash equal to the value of the shares then, and they use the cash to buy the shares. So that's a terrible answer because, one, people typically don't like to pay taxes on illiquid securities that they can't sell, and usually you can't sell them right away. Usually you have to hold them for some period of time. And two, if someone's helping create the value that they're being taxed on later, that's really not great either. I mean, and this is a kind of a classic scenario, some company hires you, and I've seen this happen so many times. Some company hires you, and when they hire you, their option strike price is, say, $1 a share or something. Let's make up a number. And they say, well, our board's going to grant the option to you, or the equity award to you formally, at their next meeting after we hire you or something. Because under the tax law, you can't really grant the equity award, or the securities law, you can't really grant the equity award until they actually start working. But anyway, they start working, and then by the time the board gets around to granting the equity award, the price has gone up from $1 to $1.80 or something. And then the worker feels like they kind of got ripped off, which is kind of true. But anyway, because the way the U.S. tax law is set up, treating these transfers, illiquid shares to people as if we transfer them cash and then turn around and use the cash to buy the stock, this is what drives these crazy things that we do. This is what drives us into the stock options. Like, this is why we grant stock options. And the tax law says, well, if we grant stock options at fair market, at not less than the current fair market value of the shares, the receipt of those options is tax-free to the service provider. So that's helpful. So we can kick the can down the road. That's also what drives, the trouble. I mean, what you'll see, and you probably remember, I was around at the time, but there was a time when Microsoft and Amazon, they used options, and it worked out well for Microsoft because they used non-qualified stock options. I'm not sure if you're aware of this or not, but a non-qualified stock option, when it's exercised, the spread is actually, even though the spread is a non-cash item, right? No one's paying the spread in cash to anybody. The company gets a deduction for that spread. And so that worked out well for Microsoft in its early days. There was tons of deductions there to offset their taxable income. But in any event, if what Microsoft experienced and what Amazon believed it was going to experience was basically a flattening out of the stock price for a long time. And if your stock price goes flatline, well, then the options aren't worth anything. And so that's why they switched to RSUs. RSUs work great when you have a company like Amazon or Microsoft, where you can actually sell some number of the shares you get right away to pay the taxes. And that's what you have to do at Amazon. I mean, Amazon pays people, I think the maximum cash salary for people is like $165,000 or something. The rest is paid in RSUs, and you literally have to sign up to sell like a third of the shares you get right away, right when you get them, because otherwise you can't pay your taxes. In any event, we do options primarily in private companies. RSUs aren't typically adopted by private companies until they're much further along and getting close to a public offering event. So usually what you run into is not long after a company is founded, and it depends on the company, maybe it's 6 or 9 months or a year, some number of months or years after a startup company is founded, the value of the company is such that it's basically too expensive to give people shares anymore, or people don't want to pay the tax on the received shares anymore. So you start granting people stock options. And stock options can be great in the sense that you can kick the can down the road under the IRS's valuation principles. You can grant people the 409A valuations can still be low relative to what investors are paying for their shares. So it's not the end of the world, but it's kind of an unfortunate tax setup we're in to start. So yeah, the typical award is a stock option, either an incentive stock option or a non-qualified stock option. The incentive stock options can only be given to employees, so they can't be given to advisors or consultants or board members who are purely board members. Those people have to receive non-qualified awards, non-qualified stock options. But incentive stock options can be given to employees. They're subject to some size limitations, so no more than $100,000 a year can become exercisable. Beyond that, it's treated as a non-qual. And most companies, I think in general, most companies are trying to be the most aggressive about what they're offering new hires. I mean, most companies will offer people ISOs, because ISOs have theoretical benefits over non-quals. The theoretical benefits being, if you can meet the 2 holding periods for the incentive stock options, there are 2 holding periods. If you meet those holding period requirements, then you can theoretically have a capital gain on the sale of the ISOs. The trouble is with ISOs, and it's one that people frequently miss. They hear people say all the time, well, there's no ordinary income taxes on the exercise of an ISO. And while that's true, the spread on the exercise of an ISO, the difference between the fair market value of the stock at the time of exercise over your exercise price, that spread is what's called an alternative minimum tax adjustment, which means there's no ordinary income tax withholding on the spread, but the company is going to issue you a statement, kind of like it would issue a W-2 or a 1099 by January 31st of the following year. They're going to issue a statement. They're going to send a copy to the IRS telling you what your adjustment was, your AMT adjustment. So when you go to your tax CPA or when you do your personal tax return, you're going to create your tax return, you're going to fill it out and calculate your ordinary income, and then you're going to calculate your alternative minimum taxable amount, and you're going to pay the greater of. And a lot of people, especially after the dot-com crash, I don't know if you remember this, but after the dot-com crash happened, a lot of people who had exercised ISOs, say at Cisco, and then the market crashed. They ended up owing millions of dollars in AMT that they couldn't fund because the stock market crashed. And if you go way back in time, and I have a blog post about this somewhere, I could probably find it for us, but Congress actually passed a law, which, and I forgot what year this passed. It might have been as late as like 2008 or 2010 this law passed, but this law, and the law never made it into the statute books. It's just the general law of the United States, just embodied in the statute that Congress passed. But the law said, hey, look, if you exercised an ISO, okay, and you didn't pay the tax, it was forgiven. But for those people who paid the taxes, they couldn't get a refund. But there was such an outcry about like all these people who went bankrupt inadvertently by exercising ISOs and not nearly selling shares and then the market crashing. They actually passed like a one-time reprieve for this. One of the beauties, I guess you'd say, maybe, I mean, it depends on your point of view, but one of the beauties of a non-qualified stock option anyway is that on exercise, the company has to, if you're an employee, not if you're a contractor, but if you're an employee, the company has to withhold the income and employment taxes on the exercise of a non-qualified stock option. So at least you can't sort of escape thinking about the taxes until the following year when you might find out you're in trouble. Because I think, a lot of people are just generally confused about the alternative minimum tax, don't know how to calculate it, and they kind of miss it. But in any event,
if we step back a little bit, so when a company is creating these opportunities for incentive ISOs, restricted stock options, ESOs, I think that's the same as. What are the 3 or 4, 5 most popular categories that mid-stage or startup companies will create for their employees?
Yeah, sure. Yeah, usually a company at the time of formation will adopt an equity incentive plan, and usually the equity incentive plan will enable stock options, both incentive stock options and non-qualified stock options, and that plan will also authorize immediately exercisable stock options and also typically restricted stock awards, which are just stock awards subject to vesting. So that's kind of the general basket of the kind of awards that companies set up in these plans is available to the company going forward. But most companies will just use the option path, for the bulk of the life of the company.
So is there a particular baseline that's regulated by, the SEC or FINRA or the taxable environment, state or federal? Is there a basic framework, and then you have companies iterating on that? And what does that iteration look like, if so?
Yeah, well, okay, so it's a good question. So we talked about this a little bit earlier, but the two big, there's sort of multiple overlays here, right? One is there's the corporation law of the state of the incorporation of the business entity, and so you've got to comply with corporate law with regard to stock options or equity grants. Then there's the securities law overlay, and then there's the tax overlay. The securities law overlay informs a lot of how things work. I don't know if you're aware of this or not, but under the federal securities laws, the exemption for granting equity to service providers is Rule 701. And Rule 701 says if you have someone who's not accredited, they don't have to be accredited. If they have someone who's providing services to the company, and you want to pay them in equity, Rule 701 says you can do this as long as it's pursuant to a written agreement or plan, and you observe certain mathematical restrictions and or disclosure requirements. So going back in time, a long ways, I suppose all the way to the Great Depression, when all these securities rules were first invented and created, the idea was securities were dangerous and people lost money. And so there's actually limitations on what you can do in terms of, like, there are actually mathematical limitations under Rule 701 on how many options or how many equity awards you can grant to all of your employees, which might sound kind of strange. Why would you limit the amount of equity you can share with service providers? It feeds back, or it funnels back to this idea, well, these are potentially dangerous instrumentalities that we have to control. And so there's actually limitations on how many equity awards you can give. What Rule 701 says is you can give the greater of either $1 million in equity awards during a 12-month period, 15% of balance sheet assets as the most recent balance sheet date, or 15% of the outstanding securities of the company. And so you have these three, you get to choose the greater of the three limitations. For most early stage startup companies, in the early days, you have that $1 million 12-month allowance, and so you're never going to run over that because you're granting options at a very low price. But the way you calculate the $1 million is, how many options at the strike price, and did it go over $1 million in a 12-month period? And if it did, then you've got to observe one of the other limitations, either the 15% of balance sheet assets, which most companies aren't able to observe because they don't have any assets, right? If you're creating IP and you're paying people to create IP, you're not booking the value of the IP as an asset on your balance sheet, and you're deducting all the expenses of the creation. So basically, your balance sheet assets are usually not that great. But you've got this 15% of the securities of the company. You can go up to that limit during any 12-month period too. And then on top of that, if you go beyond $10 million during any 12-month period in grants, you've got to provide disclosure documents to optionees before you give them the awards. And I don't know if you remember this or not, but that rule used to be $5 million required disclosure, financial statement disclosure, other disclosures about the business. And you might remember that when Google was going to go public, it had to delay its public offering because Google had flagrantly not observed the disclosure rules under Rule 701, went way over the limits. And so literally, I mean, if it had been any other company, it might have killed their IPO. But of course, Google, they filed a public disclosure document with the SEC. They gave all the optionees the right to take cash and give back their options to take cash. I'm sure no one did. Like, why would they? Your company's about to go public and become worth, so much more. But they literally got hung up because they didn't follow these rules. And so the rules are real. They can be painful for companies, especially companies that are, that are granting more than $10 million during any 12-month period in equity awards. You got to provide these disclosure documents to people. And so equity plan administration becomes somewhat of a burden. And then, so you've got this federal securities law overlay, and then the federal securities law doesn't trump the state securities law. So then you have to comply with also the state securities laws of each state in which you have an investor or optionees or equity award recipients resident.
Oh, so actually state law takes precedent over federal law. Federal law is an overlay?
They exist side by side. You got to comply with the federal law and you have to comply with the state law. And so, for example, in California, if you have optionees or equity award recipients in California, it might sound kind of strange, like if you're new to this area, but yeah, you actually have to file a form and pay a fee to the California securities regulators to comply with the law to grant stock options and other equity awards to optionees in California. Oregon has a similar rule. Washington State's rule is that, well, if it's a board and shareholder approved plan under which you can grant ISOs, and you're granting either ISOs or non-quals, you don't have to file anything with the DFI.
So how does that differ from, like, you will see most corporations filed as an entity in Delaware,
yep,
but have corporate offices in different states and then employees in multiple states. So how does all of that play out?
Yeah, so the federal law applies regardless of where you're incorporated. The state laws that you have to comply with are the state laws of the residence address of the optionee and also the corporate headquarters state, whatever that is. But usually what you're looking towards is, in terms of state law compliance, is where does the optionee live? And we have a 50-state guide we maintain. So if clients call us and say, hey, we're granting an option to someone in Arkansas, we can quickly go and look at our resource and see if there's any filing. Many states don't require any filing at all. There's a handful of states that require filings and the payment of fees, but most states are no filing states, as long as you have a plan that meets certain specifications.
So let's talk a little bit about a personal situation. When I say personal, I talk about some of the attendees here and the various people that we're having conversation with who are employees of companies who want to balance their asset through sales of their convert their options into shares and then sell their shares. Obviously, with the run-up in valuation, a lot of these employees, let's assume, started with the company in 2018. That a strike price of 50 cents, or the 409A was like $1.20 maybe at that time in 2018. several rounds of funding. The valuation is like $2 billion now. And that was in 2021. And they said, whoa, my company's doing great. My paper value is like, $500,000. I want to hang on to it. It seems like everything's going in the right direction. Arrived 2022 and 2023, the valuations have plummeted between, 60 and 90% now of certain companies. And even though the strike price was much higher, the valuation of what someone is willing to pay for your shares is significantly lower. So all of a sudden, you have an employee trying to exercise some of their options into shares and shares that they want to sell. How do they figure this out? Because there's a strike price, there's an intended value, but there's no value in the market.
Right. Yeah. Well, when you exercise the option, you'll want to know from the company, like if it's a incentive stock option, you'll want to ask the company, well, what's the current 409A valuation price for this common stock, so that you can spec out the alternative minimum tax adjustment you'll have. So you kind of know, you can know if you're going to get in trouble or not from a tax point of view from exercising it. Similarly, if it's a non-qual, you'll want to know the 409A valuation so that you can anticipate what the tax withholding is going to be. Because frequently, employees, when they go to exercise their stock options, the strike price itself is not not a trouble from a funding point of view, because just like you said, they joined the company a long time ago and they have a really low strike price. They can typically write a check to cover the strike price, but they can't just write a check to cover the strike price. They also have to, if it's a non-qual, write a check to the company for the income tax withholding that's required on the spread. And the income tax withholding is going to be the supplemental wage withholding rate, which I think might be 22% now, might be 25%. I always forget which. It's one of those rates that Congress always kind of monkeys with. But then employment taxes as well. If you've gone over the FICA limit, would be an additional 1.45 to the employee. And if you haven't gone over the FICA wage base, additional 6.2 plus 1.45 to the employee, plus the income taxes. And that's disregarding state income tax withholding as well. So the income taxes or the EMT taxes that arise as a result of the exercising option can be a lot more significant than the strike price themselves. And employees just need to figure it out before they exercise, so they know what they're getting into and they can pay the taxes. And I've seen plenty of situations, unfortunate situations actually, where an employee, has vested, they have cheap options, they want to go do something else with their lives, they quit, they only have 90 days to exercise their option, and then they find out literally that they can't even afford to pay the taxes and they have to walk away from them. So the big thing for employees on exercise is just get a fix on what the taxes are going to be, so that you can understand them and make sure you can fund them.
Yeah, before we go to some questions that were coming up in the Q&A in the chat.
Yep.
Over the last, perhaps during the period of 2018 and 2022, there were a number of companies who actually did not create the traditional pools that you're talking about, RSU, ISOs, etc. What they did do was, if they were a company especially involved with crypto or technologies, layer 1, layer 2 technologies in the blockchain industry, created tokens or coins, and that was issued instead of the traditional fund option pools or stock options. I mean, how is that viewed, and is that correct? I mean, what's clarity on that?
Yeah, it's a good question, because certainly tokens, if you're working on a blockchain project and the tokens are going to power the blockchain, or they're going to have utility on the blockchain and people are going to want to pay for them, there's going to be a market for them. It would seem natural that you'd want to incentivize people with them and pay them with them. That would seem like a natural thing to do. Unfortunately, the law is, and I know you've been watching this, but the SEC and the securities regulators are really going aggressively against crypto companies in all sorts of different ways, shapes, and forms. But if the tokens are securities of the issuer, then you've got to comply with all these states and federal securities laws, just like you would with stock options. So, if they're securities, you got to comply with securities laws. If they're not securities, well, that's awesome. However, I think, the securities regulators, I think for the most part, view all of these tokens as securities. I think, I joke with people about this, really the test for security from the regulator's point of view is there someone to blame? I mean, is there a management team that we can sue? And that's why Satoshi, whoever he or she or they was so brilliant, because he can't be found. He can't be found. There was with regard to Bitcoin, there's no management team to blame, which makes Ethereum a hard one to say is not security, because there is a management team to blame there. And I think Ripple has a management team. It's a very difficult environment for tokens. But in general, I love the idea, like awarding people or paying people in the same security or the same token or your users are going to use to access the blockchain. That seems like a natural thing. It's just too bad that we have a regulatory environment that makes it really tough.
So basically, there is no clarity there yet, and there might be actually quite an outcry when this SEC or FINRA gets their hands on these coins or tokens that were given to employees as compensation.
Yeah, and I don't know if you saw this or not, but there was a couple of people who worked at Coinbase who were, I think they were convicted recently of insider trading of, tokens that they were accumulating tokens which hadn't been yet listed on Coinbase in anticipation of them being listed on Coinbase, because once a token gets on Coinbase, the price goes up. And so, the regulators' views on these things is, pretty negative. The U.S. regulators' view on these is really pretty negative.
As an employee, what we're finding is in these days, it was not similar. It was not the same a year and a half ago, even. But what we're seeing now is a lot of companies have just issued a blanket statement that they will not allow any transactions by any employee to exercise to an outside or third party any of their equity. What is your thought on that?
Yeah, first off, if it's a Delaware corporation, you can go look at Delaware Corporation Section 202. Delaware does allow companies to do flat out prohibitions on transfers of shares under certain circumstances. And I don't know, we didn't really touch on this earlier, but generally speaking, when you exercise your option, assuming you can pay the taxes and exercise everything else, you're making, at the time of exercise, you're making a bunch of securities law representations and warranties about your intent to hold the asset for investment purposes, not for distribution or resale or anything like that. And so the law requires you to have this intention to hold the thing indefinitely. It's most of the time the documents say you intend to hold it indefinitely. Of course, we don't mean that indefinitely in the plain English meaning of the word, but generally speaking, you've got to have an investment intention to hold the security long term to even exercise it. And then on top of that, the companies will place a right of first refusal on your shares so that you hold it for a long enough period of time, a year or something, and then try to go sell it. You still have to go through a ROFR process with the company. Many companies also impose, and it's something for you to look at when you are taking a job, but many companies also will look at or place fair market value repurchase restrictions on shares as well. So if you quit, go to work for a competitor, violate your non-compete or non-solicitation agreements or whatever else you have in place with the company, they can buy your shares back for even the best ones for fair market value. So there are a lot of restrictions on these securities, and generally you can view from the company's point of view, you can see how the company doesn't necessarily want there to be a active trading of these. When you gave someone an option to incentivize them to do a job, you didn't really give them an option so they could go and sell it to somebody else who's not even working for the company. And so you can see the company's perspective on this, but it does make it, frustratingly difficult for employees. I mean, they're in a position where, like, well, hey, I worked for this, and I should be able to access the value of it. And it's under most states' corporate laws, a share of stock of a company is personal property. It's personal property, and sure, a company can put a ROFR on it, but you can still, if you go find a buyer and you've held it for long enough to satisfy the securities laws and transfer, there's no reason why you can't go sell it. One of the sort of, I guess, maybe call it an innovation that I've seen over the past, I don't know, 10 years or something is, I mean, there are companies and financiers or investors who essentially will buy like a forward call option on your options. So they'll basically say, okay, you've got these options or these shares. We're going to give you a bunch of money today. It's technically a loan, but you don't have to pay it back when your shares become released from their ROFR. So 6 months after the IPO and they're released from the ROFR, or if there's a sale of the company, whenever the shares become transferable, then you're going to transfer them to us. And then we're not going to charge you the interest at that time. But it's kind of a manipulation of this idea, like you've got people who work for something, it's their personal property. Why shouldn't they be able to monetize it? And you've got people who will do these transactions. We'll give you the money. We're not taking title of the shares now. You keep title, but later you're going to send it to us. So effectively circumventing, in many ways, a lot of what the plain English of the rules say in all the legal documents. But
well,
yeah.
You go ahead. No,
well,
so it's like.
Go ahead. Sorry.
No, so I mean, I think there's a little bit of a change in that environment because the SEC and FINRA are looking strongly at this. It's like, first of all, are you really allowed to do this? Secondly, the investor may be left holding the bag if at that point of IPO, the ownership still belongs to the employee. And this is, that's okay. I still own it. So come chase me if you want. I mean, there's going to be a lot of perhaps.
Yeah, we'll see. I mean, I think a lot of those transactions were done. So we'll see how they turn out. But in any event, I agree. It can be frustrating from a worker's point of view to, on the other hand, I mean, companies look at it as golden handcuffs, like the poor employee I was talking about earlier who worked 4 years, who was fully vested, who wanted to do something else with her life and basically got robbed of her options. I mean, that's a really super unfortunate situation. But you can see from the company's point of view, it's like, well, we didn't want her to quit after 4 years. Really, we wanted her to stick around until we sold the company. I mean, that'd be but why a 4-year vesting period then? I mean, yeah. Anyway,
I'm going to let Irene take over. Irene to take over here for a little bit. There are a bunch of questions, and Irene, if you jump in and ask those questions, that'd be great.
Yeah, no problem. So Catherine is asking, if you hire employees from outside the US and you want to offer a stock option to them, what do you have to consider?
Yeah, it's a good question. So the US securities laws weren't designed to protect non-US people. So that makes sense, right? I mean, philosophically, I think we can agree that at some level that makes sense. It's a US law designed to protect US people. There is a US securities law regulation, it's known as Regulation S, that essentially allows you to sell securities or issue securities to non-US persons, as long as they observe certain rules under Regulation S, primarily that they not turn around and sell to a US person right away. You can issue securities without regard to the Rule 701 limitations or the Regulation D, accredited investor limitations to non-US persons. Obviously, subject to local law of whatever jurisdiction that is, but a lot of countries don't have any prohibitions on issuing securities to people who live there from US companies. So,
okay, awesome.
So there's alternatives. You can rely upon the Rule 701 under federal law, or you could rely on Reg S for non-US persons. So.
Okay. How do I know as an employee that I'm being offered a fair equity compensation package?
Great question. So first, I mean, if I was and by the way, in the Holloway Guide to Equity Compensation, which is a free online resource, so you can go there, and there's a section on, hey, what questions should I ask before I take this job, or when I'm trying to evaluate if I've got a fair deal or not, how do I evaluate it? And certainly, one question to ask is, well, what percentage of the company am I being promised here in this situation? I mean, if someone says, oh, we're going to give you options to buy 200,000 shares, it might sound like a lot, and you might think, wow, this sounds great. But then, that might represent like, 0.01% of the company's capitalization or something. So the company should be willing to provide you some basic summary level data about the company's capitalization, what issued and outstanding shares, share reserve on it. You should get a copy of the plan, which says the share reserve under the plan. But basically, you just want to know, you want to sort of test the percentage you've been promised to see if it's accurate, or if the number of shares given to you maps to the percentage you expected. And you can look online. I don't know if you have access to Carta. Carta has data. The Holloway Guide has, if you just Google standard ranges for different types of hires, you can find out, for a, venture back or a Series A venture back company, hiring a chief marketing officer or director of marketing, or search for usually there's published sort of guidelines as to what sort of is market for these positions. Of course, there's lots of variations from, these published figures. There was a pretty fun essay, I think it's still on the internet. It's called, I think it was published originally on Medium, and it was titled, Be Like Steve, not Steve Jobs, be like Steve Ballmer. And it was all about Steve Ballmer and how he was so much better than Steve Jobs in terms of what he accomplished in his career. And it's written kind of tongue-in-cheek, and it's kind of fun. But apparently when Steve Ballmer joined Microsoft as employee number 30, he was awarded 8% at that time. Wow. So pretty healthy. 8% was pretty healthy for employee number 30, I think, for any, even, by any standards, today's standards or yesteryear standards. But not sure if that answers your question or not.
I think it does. John Murray is asking, ROFA, right of first refusal, a private company's option to buy back someone's shares before they can sell to others. John, sorry, John, is that a question, or are you just responding to somebody else? Regardless, I'll move on to Rachel. If Rule 701 is Rule 701 different for state versus federal? Is federal law the same as WA law?
Yeah, so by the way, on the right of first refusal, yeah, the way it works is, and what these provisions typically say, and I mean, you can easily find an example of one if you Google around, but they basically say, hey, if I want to sell my shares and I get an offer from someone to buy my shares, before I can sell them to that third party, I've got to go and offer them to the company to buy from me first. And if the company passes and doesn't buy them from you, then I can go ahead and sell them to a third party. And sometimes you'll see companies, well, frequently companies will have the right to assign those rights of first refusal to other people, and they'll effectively assign them to their investors. So it's just a way of investors in companies being able to control their cap table. So that's sort of how the right of first refusals work. But as far as the federal and state securities laws go, yeah, Rule 701 is the federal law, and then each state's securities laws are different depending on the state. So in California, the statute for equity awards to employees is 25-102-0. In Washington State, it's RCW 21-20-310-10. Anyway, each state's law is different. It's a little bit painful, but that's why you hire a lawyer, so you can make sure you check all these boxes.
They can do the hard work for you. Shelley is asking, as a percentage, how much should a founder set aside for their stock option pool, and how long should that pool last?
It's a great question. Okay, so what I usually see is somewhere between 10 and 15% set aside in the pool. It can be higher. A little bit depends on the type of company you're building and how big you expect the team to be, and whether you know that there are some key hires that you're going to have to make. So, for example, if you're a spin out from the University of Washington, say, just using this as an example because it's one I'm familiar with, I mean, you're probably going to need to hire a CEO, maybe. And And so you're going to have to set aside maybe a greater amount of equity to provide for that person when they come on. So I see typically between 10 and 15%, but it can be higher. It can also be a little lower. The favorite game of the venture capitalists is to, if you don't have a large enough equity incentive pool set aside or available, they'll make you up it before they close their financing, and they'll make the people other than them take the dilutive hit for increasing it.
Okay, great. Just FYI, Gavin has just posted in the chat the link to your book. So if you
that's great.
check it out,
Yeah, and by the way, I'm happy to. I mean, we're gonna run out of time here in some number of minutes, but I'm happy to email me. You can email me at my law firm. I'm happy to reply and share information about any of these questions too. So.
Yeah, that's fantastic, actually, Joe. If we'll send a follow-up email to everyone here with the recording, and if we can include, if you're happy to include your email, that would be great.
Yeah.
Another question is, why is the vesting schedule so important?
Okay, well, I mean, fundamentally, and I've seen this mistake, made by a number of companies that didn't ask for my advice before they did it. But I mean, the classic example of a mistake you can make is, let's say we have a company, the two of us, and we want to hire a new CEO, let's just say, or someone important, and we give them, let's say we want to give them 50% of the company. And we do, let's say we give them 15%, and then like a couple weeks later, they just go dark and they leave town and we never hear from them again. I mean, that basically kills your company. I mean, how you set aside a bunch of equity for someone who no longer works there, and that if you didn't set up correctly, you can't recapture. And now it's so-called, dead equity on the cap table, and you're not even going to be able to get the company funded. But this question relates back to sort of the fundamental problem that we're trying to address. If we could pay people in shares of stock after they did the work for us, and we could pay them, tax-free in shares of stock after they did the work for us, well, we wouldn't be playing these games where we say to people, instead, we say to people, hey, we're going to assume you're going to work here for 4 years. We're going to assume you're going to work here for 4 years, and we're going to assume that you actually meet all the goals we set for you and you perform swimmingly. And we're going to give you an equity award that pays you as if you did all that work. I'm going to give it to you today at today's price, so you get the value accretion on all that. But what if they don't perform? Well, then we need to recapture it because they didn't perform. So it's this this vesting thing is a contraption built to get around, not being able to pay people in stock tax-free after they've done the work.
Yep. Okay, so what happens if someone leaves the company prior to the vesting period finishing?
Usually the way the plans are set up is the unvested shares are automatically repurchased by the company, like 60 days after departure date or 90 days after departure date. Usually the plans are set to automatically repurchase the unvested shares unless the company takes like an affirmative action to not repurchase them.
Okay. Catherine Cunningham is asking, what again is the ideal range for vesting for C-suite, for advisors, for board at the beginning of the company?
So what I see for, it's different for advisors, because advisors are typically coming on for a shorter period of time. I mean, advisors might vest over a year or 2 years. Advisors, you usually don't sign up an advisor to vest over 4 years because you don't expect them to be around 4 years. The other thing I see happen with advisors also is that it's a little unfair for an advisor who does come in, maybe do 6 or 9 months or years worth of work. It's a little unfair to tell that person, okay, within 90 days of departure, you've got to pay us to exercise your options or they expire and go back to the company. So what I frequently see with advisors is a longer post-termination of exercise period for them, maybe 5 years after they quit, or maybe even as long as 10 years. And there is a list of maintained on GitHub by, forgetting the person's name right now, but there's a list maintained on GitHub by someone who, of all the companies that have extended their post-termination of service exercise period to longer than 90 days. So many companies have extended it to full 10 years from the date of grant. Okay. So it's something that you should think about negotiating for if you are going to go take a job with a company. I mean, you try to negotiate for a longer post-termination of exercise period. But for employees and for founders, I usually see the 4-year vesting with a 1-year cliff as the typical starting point.
Okay, so actually that's relevant for Hani, who was saying at the very beginning of this conversation, he actually advises company in exchange for future equity.
Okay.
So that's a relevant point. Hanny's also asking, please also discuss qualified small business stock definitions and tax benefits.
Yeah, this is a big thing. If people haven't heard of this, under the U.S. Internal Revenue Code, there's a section, it's section 1202, and in that section, the Congress has made it, has essentially enacted a capital gains exemption for qualified small business stock held for more than 5 years. And the exemption amount is $10 million, although it can be greater than that. But for purposes of this discussion, it's 10 million bucks. So if you think about this, you got to form the rules are you got to form a domestic C corporation. So you form a Delaware corporation, a founder's stock can qualify as long as you're in a qualified trader business. And a qualified trader business generally means any trader business other than services businesses like law firms or dentists or actuaries or accountants. No services related businesses, no hotels, motels, restaurants, mining companies. There's a list of companies that are excluded, but most tech companies, building software, commercial SaaS companies, most tech companies can issue qualified small business stock, and that's great. Hold it for 5 years or more, exclude up to $10 million from capital gains entirely. And stock options exercised, for shares of stock, when you exercise them, and if the company, can issue qualified small business stock at that time, the option shares can qualify as qualified small business stock. So it can be a really nice exemption, and definitely one that I think is really accelerated the move to C corps. I mean, when I started practicing law, today everyone I think starts as a C corp because they're thinking we want the qualified small business stock exemption. We can't do an LLC, can't do an S corp and get those benefits. Got to be a C corp. So I think that's one of the reasons why everyone does Delaware C corps these days, because of this exemption.
Interesting. Okay, I know we're coming up to time, but I have a last question, which is, what is the fine print that an employee should look out for?
Yeah, that's a good question. So I would look out for whether the company has a fair market value repurchase right on your equity or not. You can expect that they will have a right of first refusal. You can ask and see if they have a flat out prohibition on shares transfers at all. That's a fair question. Obviously, get data on the summary cap level data, so you can understand the cap table. If you're joining a later stage company, you might also want to know what the liquidation preference overhang is. If you have a company that's raised $1 billion in venture capital, then there's probably $1 billion in liquidation preference, which is going to have to be paid off before common stock gets anything. If the company has done a 409 evaluation, that's a good thing to ask for as a mechanism for educating yourself about the company.
Okay, fantastic. Karim, I know you'll want to have a few last words before the hour is up. I think we're done on all the questions. I've got through most.
Irene, thank you so much. It was great listening to the questions and answers. Actually, Joe, thank you. This has been great. We did have a comment in the Q&A saying I was bopping around a little bit without creating a base for understanding, and
probably me. It's probably me.
No. Yeah, and I apologize for that for anyone who was there that got a little bit confused. But there's so much to cover, and there's so many finer points and so many details that I wanted us to get through. And I apologize for that to anyone who found that we were skipping some basic steps. But Joe, thank you so much for doing this with us. It's been very, very helpful for us to understand this, the clarity of it, and as we continue to tread in this uncertain times, I think clarity of employee rights, clarity on employer rights and their bandwidth to make changes unilaterally to someone's assets or promised assets is something I think will become a forefront issue, as I've seen more and more questions being asked by holders of options and shares. Bringing and surfacing that is a really important aspect, and I really appreciate you bringing that up, helping us understand that a little bit more. Joe, do you want to close us out? And thank you for allowing. What we will do is, there were several people who registered for the event, but not everybody showed up. Thank you for allowing us to share your email. If you will take questions or email questions from them, that would be great. But do you want to close us out with a few parting words?
Well, it was nice to talk to everybody. Yeah, like I said, happy to, if I can be a resource to anyone out there in the world. Yeah, our philosophy is, let's share the information with everyone so everyone can make intelligent choices about what's going on. And there's really, I mean, especially with ChatGPT available today, there's really no hiding the 8-ball. I mean, so I'm a big believer, though. I mean, just let's let everyone understand all what the rules are, so everyone can play the game in the most enlightened way possible. And anyway, if I can help people, don't hesitate to email me.
Thank you, Joe. Thank you, everyone here, the Linqto team that helped organize it. Thank you most to everyone who attended and participated. Your questions were very helpful, and the answers that Joe provided were enlightening, to say the very least. So thank you, everybody.
Thank you.
Thanks so much, Joe.
Bye.
Thank you.